Today, we're breaking down how people try to predict Bitcoin's price and whether it actually works. Welcome to Bitcoin Bytes HQ, simple Bitcoin explainers. This is educational content only, not financial advice. Let's go. If you have ever checked Bitcoin and wondered whether it will go up or down tomorrow, you are not alone. People constantly ask this question because our brains prefer certainty. Money feels safer when we think we can see the future. But Bitcoin is not a company with earnings reports, and it is not controlled by a central authority. It is a decentralized network operating under fixed rules that anyone can verify. Predicting price therefore means interpreting behavior, incentives, and patterns rather than analyzing a CEO or quarterly profits. One common method is technical analysis. This approach studies historical price charts to identify recurring patterns. Imagine observing traffic at a busy intersection. If cars frequently slow down at a certain corner, you might expect similar behavior tomorrow. Traders draw support levels where buyers historically step in and resistance levels where sellers tend to appear. Moving averages smooth out short-term volatility to show broader direction. Indicators such as the relative strength index attempt to measure whether the market is stretched too far in one direction. The fear and greed index adds another layer by tracking overall market emotion. Think of it as a sentiment thermometer, showing whether participants are nervous or confident. Technical analysis organizes probabilities, but it does not guarantee outcomes. The second approach focuses on fundamentals. Bitcoin does not generate profits like a corporation, so traditional stock metrics don't apply. Instead, analysts examine network strength. Hash rate represents the computing power securing the system. A higher hash rate is like having more referees enforcing the rules, increasing security and confidence. Mining economics also matter. When miners are profitable, they may hold more Bitcoin instead of selling immediately, reducing potential supply pressure. Halvings are another core fundamental. Roughly every 4 years, the issuance of new Bitcoin is cut in half. This predictable reduction in supply has historically influenced long-term price cycles, although it does not guarantee a specific outcome. Scarcity alone does not create price appreciation, but it changes the supply dynamics that markets respond to. Some analysts use visual tools to make these cycles easier to understand. For example, the Bitcoin spiral clock created by the Rational Root maps historical price cycles and halvings into a spiral format. Imagine a clock where each rotation represents a full market cycle. The visual emphasizes how scarcity and time interact. It does not predict a precise number, but it helps illustrate recurring phases of expansion and contraction. On-chain analysis adds another dimension because Bitcoin's ledger is public. Analysts can measure active addresses, long-term holder behavior, exchange inflows and outflows, and coin dormancy. Imagine a jar of coins. If people are removing coins from circulation and storing them long-term, it signals saving behavior. If large amounts move onto exchanges, it could indicate potential selling pressure. These metrics provide transparency that does not exist in most traditional markets. Together, technical analysis interprets psychology, fundamentals measure network strength, and on-chain data reveals behavior within the system. They form a framework for understanding Bitcoin's movement, but they cannot eliminate uncertainty. Global liquidity, regulation, leverage, and macroeconomic shocks can override historical patterns in hours. With that foundation in place, we can now explore how quantitative models and artificial intelligence attempt to formalize these insights into structured predictions, and why even advanced mathematics cannot remove uncertainty. When I first started learning about Bitcoin, I assumed that enough data and computing power could produce an accurate future price. The insight I gained is that markets evolve. Patterns that once worked can weaken as participants adapt. Instead of certainty, models offer probabilities shaped by assumptions. Quantitative models attempt to structure Bitcoin's behavior mathematically. A well-known example is the stock-to-flow model, popularized by PlanB.
This framework compares existing supply to new issuance and suggests that increasing scarcity may influence value over time. Other analysts, such as PlanC, Raoul Paul, and Lynn Alden, incorporate macroeconomic cycles, liquidity conditions, and adoption trends into their models. These individuals demonstrate that there is no single correct framework. Each emphasizes different variables. However, models face limitations. One major issue is overfitting. Overfitting occurs when a model is trained so precisely on past data that it memorizes noise instead of identifying durable relationships. Imagine studying for an exam by memorizing last year's answers rather than understanding the subject. If the questions change, memorization fails. Bitcoin's market structure evolves across cycles, which means a model that aligned with one environment may struggle in another. Another challenge is correlation versus causation. Two variables may move together without one directly causing the other. For instance, Bitcoin has often risen during periods of expanding global liquidity. That does not mean liquidity mechanically guarantees price appreciation. Markets reflect incentives, expectations, leverage, and narrative shifts. Artificial intelligence and machine learning attempt to analyze enormous data sets, including price history, on-chain metrics, macro indicators, and even social sentiment. These systems search for patterns humans might overlook. Yet AI cannot predict sudden regulatory shifts, geopolitical events, or structural regime changes. Bitcoin has already moved through retail-driven cycles, institutional adoption waves, zero interest rate periods, and tightening monetary environments. Each phase alters participant behavior. Markets are also reflexive. When enough participants believe in a model, their collective behavior can temporarily reinforce its projections. If confidence fades, that reinforcement disappears. This dynamic explains why some models appear highly accurate for years and then fail abruptly. A common misunderstanding is assuming that models output a guaranteed price. In reality, they express probabilities. It is similar to a weather forecast showing a 60% chance of rain. The forecast informs preparation, but it does not eliminate uncertainty. When we step back, the picture becomes clearer. Technical analysis interprets psychology. Fundamentals and on-chain metrics measure network health. Quantitative models structure scarcity and macro relationships. Artificial intelligence analyzes complex correlations. Each approach provides perspective, but none provides certainty. A tiny next step you can take is to examine some of the models yourself and familiarize yourself with how they work. Look at their assumptions, their inputs, and the timeframes they analyze. Understanding the framework behind a prediction is more valuable than memorizing a target price. That's how Bitcoin price prediction really works. Probability, not certainty, simplified. If this helped, like, share, and subscribe for more Bitcoin explainers. Drop your biggest takeaway in the comments. I'd love to hear your thoughts. See you in the next one. Thanks.